Want to get smart, fast about what's really shaping things? Good, you're in the right place. Today we're doing a deep dive into sustainable investing, looking at, what it actually is and why suddenly everyone seems to be talking about it. We've got some great source material here, and our mission is really to cut through the noise, give you a clear, useful handle on this big shift.
Exactly. It sounds complex, maybe, but the core idea, it's actually pretty straightforward. It's about thinking a bit broader than just the bottom line when you invest your money.
Okay, so let's start there. What is the fundamental difference between this sustainable approach and, well, traditional investing?
Well, traditional investing, historically anyway, has been laser focused on financial returns. Maximize the profit, right? Sustainable investing still wants good returns, absolutely. But it adds another layer. It brings in environmental, social, and governance factors. ESG.
ESG, right? That acronym is everywhere. Can you break that down? What are we really talking about with E, S, and G?
Sure, so E is environment. Pretty clear a company's impact on the planet. Think carbon footprint, waste management, water usage, things like that. S is social. This covers how a company interacts with people, its employees, suppliers, the local communities, diversity, labor standards. And G is governance. That's all about how the company is run. Leadership structure, executive pay, audits, shareholder rights is managed well and ethically. Together, E, S, and G give investors this framework for assessing a company beyond just the numbers.
And why the huge surge in interest now? It feels like it went from niche to mainstream pretty quickly.
Yeah, it really has. There are a couple of big drivers, I think. First, simple values alignment. A lot more people want their investments to reflect their personal ethics. They don't want to fund things they disagree with. Second, and this is crucial, there's a growing understanding that these ESG factors aren't just nice to haves. They can actually pose real financial risks or opportunities.
Okay, explain that link. How does, say, environmental impact connect to financial risk?
Think about climate change, for example. A company ignoring carbon emissions might face future regulations, carbon taxes, or reputational damage. Or resource scarcity if your whole business depends on cheap water and you're in a drought-prone area. That's a massive risk. Good ESG can mean better risk management, basically.
Which leads to the big question, performance. Does focusing on ESG mean sacrificing returns? That's the old argument, isn't it?
It was the old argument, but increasingly the data challenges that. A lot of studies show sustainable investments performing right alongside, and sometimes even better than, traditional ones, especially over the long term. So the idea of a forced trade-off, it's looking pretty outdated.
Okay, that's encouraging. But you mentioned challenges earlier. What makes it tricky for investors who want to dive in?
Yeah, the biggest hurdle is probably measurement and standardization. There isn't one single, universally agreed upon way to measure sustainability or score ESG performance.
So different people might rate the same company differently.
Exactly. You have various agencies developing ESG ratings, but they use different methodologies, weigh factors differently. So one agency might rate a company highly, another might give it an average score. Makes direct comparison tough.
Right. So how do these ratings actually work? Where does the information come from?
Well, these rating agencies gather huge amounts of data, public company reports, government databases, news sources. Sometimes they engage directly with companies, too. They analyze all this info against their specific criteria for E, S, and G, and then crunch it into a score or rating. It aims to give investors a snapshot, but you have to remember the methodology differences.
And this lack of universal standards, does that open the door for greenwashing? Tell us about that.
Absolutely. Greenwashing is a major concern. It's essentially when a company, or maybe an investment fund, markets itself as being way more environmentally friendly or sustainable than it truly is.
Got an example?
Sure. Think of maybe an energy fund that heavily advertises its small investments in solar power, but, the vast majority of its holdings are still in traditional fossil fuel companies. It's using the green bit to create a misleading halo effect. It's marketing over substance.
So investors need to look beyond the label. What about governments? Are they stepping in at all?
Yes, definitely. We're seeing a real uptick in government action. Things like mandatory climate risk disclosures for companies making them report their environmental impact. Also, incentives like tax breaks for green bonds or investments in renewable energy projects. They're trying to nudge the market.
Does all this investor demand, government nudges, actually change how companies operate? Can sustainable investing move the needle on corporate behavior?
The potential is certainly there. When large amounts of capital start flowing towards companies with better ESG track records and away from laggards, well, that sends a powerful signal. Boards and management teams notice. It can genuinely incentivize companies to improve their practices to attract that investment. It's market pressure in action.
Are we seeing specific industries really booming because of this trend?
Oh, absolutely. Renewable energy is the obvious one. Solar, wind. Electric vehicles and battery technology are huge. Sustainable agriculture, water technology, green buildings, basically any sector providing solutions to major environmental or social challenges is seeing significant investment inflows.
Okay, let's try and wrap this up. Key takeaways seem to be: sustainable investing adds ESG factors to financial ones. Demand is surging, driven by values and risk awareness. Performance often matches or beats traditional methods.
Right. But measurement is tricky, and you need to watch out for greenwashing. Governments are getting involved, creating rules and incentives.
And crucially, where you put your money can actually influence companies.
Precisely. It's a powerful tool. And maybe the final thought to leave folks with is how this focus might fundamentally change things. Not just investing, but maybe the whole definition of corporate responsibility and the shape of the economy itself.
Makes you think. So, for you listening, maybe take a moment later and look up the ESG ratings for a company you know well. It can be quite revealing.